Hello again. Well, it's now time to hear from Ray Treverson, Fund Manager and Director, OTG Capital. In this presentation, Ray will present some compelling data and supporting numbers that show, on average, bond investing can deliver yields close to and possibly greater than the share market over the long term.
Hello and welcome. I'm Ray Treverson, and thanks for coming along and watching my presentation on the law of averages, the long-term case for investing in bonds. I'm the fund manager and director at OTG Capital, and you can see my credentials there on the slide. I also host a regular radio show and podcast called Dollars and Making Sense on my local community radio station, Radio Northern Beaches. I've been involved with a number of investor groups with the AIA in Collaroy and the AIR in DY, and I've got over 40 years of business experience and have been investing in the way that I invest for about 20 odd years or so now, and I operate OTG Capital out of Newport Beach, New South Wales. So today I'm going to be talking about financial management and portfolio structure and the case for investing in bonds. Now, good financial management doesn't happen in a vacuum. And one of the things that I guess I really hope that people take from this presentation is that they'll go back to maybe basics and look at where you start from. And a place that I often direct people to have a look at from the outset is to go to the Money Smart website, which is run by the ATO, and they have a very simple 6-step process. And we're going to be talking today about researching your investment options, and hopefully, as that graphic there shows, you know, we're not putting all our eggs in one basket and getting a lot of broken eggs. Now, given that this presentation today is to the SMSF Association, hopefully every trustee and intended trustee watching this presentation should understand that in accordance with superannuation industry supervision regs, we need all to develop and write an investment strategy and post that strategy to a trustee meeting minute. And then every year, we're supposed to outline that investment strategy to our auditor and justify what we've done with our auditor. Now, the question that I guess I'd pose to many SMSF trustees out there today is, how diversified are you? And is it the way that I normally see is cash and shares unfortunately still seem to dominate very much what's happening out there in investor land. So let's talk a little bit about shares. Don't be fooled. Look, any mug can make money in a bull market, but bull markets don't last forever. And we've had one heck of a year. Now, making money consistently over a protracted period of time is actually quite difficult. And I've gone to the web and I've picked up this very good list of stocks of the decade for the past 10 years that if you had have put $500 down, this is what would have happened to that money. Wow, there's some great results in that. But the fact is that not everybody picked these winners. You know, you didn't pick a wax stock, or not everybody got in there with CSL when, you know, you could buy it at a reasonable price. And so the question that I often ask investors is, yeah, you brag about your big one, but how many people brag about their positions in AMP or Telstra or Pasminco? And the list of losers is long. It really is. It's quite long. And I'm always surprised that the mainstream media don't pick up on this a bit more. I always thought bad news sold better amounts of newspapers than good news, but who knows? So let's fast forward now to how shares are doing today. What a world we're living in. We're 11 months into a pandemic. A vaccine at the time of this recording is now being touted by Pfizer, but regardless of when it comes out, we're still going to face a 12 to 18 month logistics headache to try and distribute this vaccine, and trust is going to be a big issue for that vaccine as well. Just to go back in history, in 1918 to 1920, when the Spanish flu hit, it lasted for 3 years. It went through 4 waves. And so given that history that we've had, I suggest that we've still got a long, long way to go before it's all over. We've got an administration in the United States that's in transition. We've got a stubborn incumbent. And regardless of whether you think he did win or not, the US Senate today is still not sorted. There are 2 final seats that have to be determined in January. Now, I've read in many, many places where Wall Street loves the fact that there's going to be gridlock, But the fact is, we don't know whether there's going to be gridlock in Washington or not yet. So we're still going to be facing a situation where until mid-January, we don't know what's going to happen. And certain things are going to happen with the market if it's a Democrat-controlled House, White House, and Senate, or it could be a totally different story. So I guess the bottom line is we've also got a situation with money printing happening. Quantitative easing is that lovely term they use. And the RBA earlier this month said interest rates are flat and won't change for at least 3 to 5 years. So against that backdrop, I would suggest to you that we've had a hell of a year. Look at that equity curve for the All Ordinaries. Nobody really knows what's ahead. And when you look at the Dow, it's just as rocky, if not rockier, a ride that American investors have had, and if you play in that market as well. What I do know, though, is that share traders love volatility, but share investors love stability. So stock picking. Now, despite what people will tell you from the industry, stock picking is not easy. And stock picking is not easy, but the industry tries to make it look easy by asking you to pay for share trading newsletters, subscriptions, stop tipping services, share trading software programs, managed discretionary accounts, and the list goes on. In researching today's presentation, I did an internet search and uncovered at least 30 or more software packages out there that claim to assist you in picking the right stocks or options or ETFs, and more importantly, timing the market. And that doesn't include the number of charting programs, which is probably 5 to 10 times that number again. Now, against this backdrop, I like to remind people of Warren Buffett's 10-year bet with hedge fund managers. Back in 2008, he famously bet expert stock pickers that an index fund could do better than the so-called professionals. And there's the result in the red circles. Wow, what a difference. And to bring it back home a little bit more local, last year, 80% of managed equity funds didn't outperform the index. 4 out of 5 didn't do better than the index. So I scratch my head and say, well, why are we paying these people fees if they can't do better than if I just go to an ETF? So stock picking, no matter how you invest, will always come down to this so-called special sauce. The never-ending stream of people at investment shows and trading houses and companies and investment firms always proclaim to have this special sauce. And I particularly like this graphic from Kung Fu Panda. In the end, the special sauce doesn't really exist for the Dragon Warrior. And in the harsh reality of the investing world, it doesn't exist for you either. That special sauce is always going to be you. Millions of dollars, doctorate qualified mathematicians, analysts, brokers have all proclaimed expertise in 1 year, only to end up looking like a fool the next. So let's delve a little deeper into some numbers. Picking shares for consistent long-term gain is just not that easy. I picked up this great article from a Motley Fool contributor who did the sums for the S&P index over the past 20 years that shows the impact of not being in the market when you miss the best days. We're looking at the impact of $10,000 being placed in the market, and after 20 years, the yield is 5.62%, fully invested. Yet, if we miss the best 10 days of that 20-year period, which is 0.2% of 5,040 available trading days, that return is slashed by 65% to only 2%. Be out of the market for the next 10 best days and you've done your money. And the question again that I would feed back to all of you listening and watching this presentation today, who sold off in March and then stayed in cash? And according to the ATO report on SMSFs recently released, many sold off shares and didn't re-enter and stayed in cash at less than 1% yield. And I guess the salient lesson for me is not everybody wins. Another wealth website that I refer to looks at 4% of stocks accounting for the entire wealth creation of the US stock market since 1926. And obviously the correlation is 96% didn't make it. And so I like lists. And one of the lists that I always refer to when people are looking at share trading is, go and do a bit of research, and here's a list that you need to comply with if you're going to consider going into shares. So there's the list. I'm not going to read it out for you. You can read it yourself in your own time. But I wanted to also show you the next list that I drew out of Investopedia, which is the most common mistakes list. Okay, so for all the good tips, there are also tricks and traps. Now, unfortunately for me, I can tick for more, at least half of these that I've made mistakes over the many years of trading and investing. And in the interests of time, my point is not necessarily going to each and every one of these mistakes, but it's simply to highlight that there are many tricks to being a solid performer in the share market. And again, to highlight my point, Warren Buffett's letter to his shareholders in 2013, he openly said, stock picking isn't for everyday investors. And Buffett actually recommended for his wife an index fund with some bonds on the side and a small holding of cash. And that's from the, one of the best, I guess, in the market. So let's look at one of the favorites here in Australia, dividend imputation and franking credits. Now, for mine, dividend imputation and franking credits have skewed many Australia's investors' thinking. Franking credits actually act like a de facto bond when you think about it, but unfortunately it's dulled investors to the declining share prices that sometimes go with it. Now, I've talked to many people at investor conferences and my discussion groups. They stay in certain stocks for no other reason than to pick up the franking credits and the dividends. And they don't even pay attention to the share price, which to me is derelict, quite frankly. I'm often surprised when I hear that. I really am. So, in fact, when you think about it, a unique part of this landscape now is that was introduced by Howard and Costello in 1997. The franking credits became fully refundable in 2000, even if there was no tax liability. So we are the only country in the world that allows this. So many share investors over the past 20 years have openly and candidly invested in these dividend-bearing shares just for those particular dividends and credits. It's all well and good if the dividend and tax credit was provided and the share price went up. But what we're enjoying now is not going to be enjoyed for too much longer. And one of the things that I think we all have to agree is I don't think we're going to be there for much longer. So let's look at bonds. And the common complaint I hear all the time is, look, Ray, bonds just don't deliver. Well, I'm here to tell you I don't think that's the case. There are many types of bonds in the market. There are the government bonds that do return very poor and very ordinary returns, but there are corporate bonds out there. And here, for example, I've listed the top yielding corporate bonds from the web, and you can click that link later yourself. And there are corporate municipal bonds, unregulated, unlisted. Now, in the asset-backed and collateralized bonds, that's what we do at OTG Capital. We lend our investors money and we collateralize it with assets, being mortgages against quality residential properties. So there are listed and unlisted bonds out there as well, and they all carry risk, whether they're retail or wholesale, secured or unsecured, rated or unrated. And this particular list that I've provided there gives you a yield of anywhere between 4% at the bottom there with Telstra, right up to 8.25% with Stockland. So if we go back to Investing Education 1.01, a bond is a loan. Now, for me, lending money is a cinch. If you stand on the street and say, hey, I'm going to lend money, people will come along and grab it. It's not the lending that's the hard part. It's getting it back is the trick. Okay. And when we think about that, getting the money back, there are gotchas in bonds as well. It's not risk-free. So one of the things that we did at OTG Capital is we wrote a number of introductory e-booklets that we've posted on our website, and you can download these for free anytime you like. And it's all about educating people about investing in bonds and what it means. You know, what are the tricks? What are the traps? And you can see the titles there, factors in when you invest in bonds, tips when you assess collaterals, and I guess some of my thoughts and opinions of why I think bond investing is better than shares. And while only 6% of Australians today invest in bonds, we're hopeful that the introduction that we provide will make it simpler for people out there, and those of you out in SMSF trustee land, might see that this is a better way of investing rather than leaving your money sitting in cash deposits. Now, one of the things that I often say to people, just about every investor out there today has borrowed money before. And so in many instances, they easily understand what it means to be part of a loan. You've gone out, you've borrowed money. Let's take a mortgage, for example. The house is the collateral, so it's not unsecured. You know what the interest rate is, the bank lets you know, and you know that, if it's a 25 or 30-year loan, it'll mature and you've got to pay it out. And I guess when you invest in bonds, it's no different in that regard. The only difference now is that you are the lender. So again, we go through this in the booklets, and I'd really encourage you all. There's no sell here. It's a free booklet. It's for education. And I've got a lot of great feedback from it because people come back and say, oh, I really didn't know that it would be that easy. And I guess that path down, the look of bonds rather than shares is what really today's presentation is all about. And so in conclusion, I find bonds provide a consistent way forward. The chart that I've got up there for you is where I've plotted our own OTG Capital Investment Trust and its yield. About a year or so ago, it was at in sixes, and now we're at 5.85. And you can see the All Ords was tracking above it for quite some time, and then March came along and the world changed. And so the thing that I keep on saying to people, look, it's a ride. It's a higher profile on the risk profile than cash. Yes, you get a better yield, but there is a bit more risk, but we certainly believe it's a manageable risk. And because you've been part of loans in the past, we believe it's simple to understand, and you understand the criteria, and you understand what makes up a bond a heck of a lot easier than shares and puts and options, etc. We think they provide modest to strong returns without the drama because it's laid out. The bond and what the coupon rate is all laid out for you, and hopefully it's a far simpler process than going to the market. And for mine, having been a day trader during the GFC years, it's none of the hit and miss of trying to pick the right time to be in shares and the right time not to be in shares. Everybody says, timing the market's great. We're there when it's going up and we're all out when it's going down. I don't see that all the time at all. So while it's argued, and the numbers support this, again, I just simply say, I'm just trying to demonstrate through numbers, charts, and averages that far too many share traders don't actually do that well. And their mutterings of having made the occasional strong gain is, that one big banger and that's it. Bonds are a reasonably simple way to go forward, we believe. And I'll always sit there and certainly contend shares will always outperform bonds over time. But in the wrap up, in the law of averages, and the big one, the investor sentiment, that special source that panics, that fears, that all of a sudden goes, oh my God, should I stay in or should I stay out? You don't need to worry about that with bonds. And so I certainly believe many people that say they're really achieving don't always. I mean, a number do, but I'm simply saying the cynic in me is maybe not quite so believing. So that's it for me. Thanks for watching. If you've got any questions, please catch up with me at our virtual booth or via our socials and emails. And our final slide is our normal set of disclaimers. That's it for me. Have a great day, and I look forward to chatting to you.
Well, that brings us to the end of the session. Thank you, Ray. Be sure to visit the OTG Capital booth to learn more about their products and services or to ask any additional questions.